Hello everyone and welcome to our first market update for 2024. Markets finished 2023 strongly as the fears that had gripped through 2023 that a US-led recession would eventuate started to disappear, and it became quite apparent that the soft landing scenario that had been discussed was starting to become more apparent. This saw markets from October to December in the last quarter take off strongly, particularly in global markets led by AI and technology stocks. The US inflation numbers have fallen quite some way from 9% peaking in July 2022 to 3.1% that was announced in January's numbers. So inflation certainly heading in the right direction in the US, which starts to open up the conversation or the dialogue around rate cuts. And markets are currently pricing in approximately 5 rate cuts for 2024 in the US. In Australia, closer to home, the RBA didn't go quite as far as the US in terms of their rate hiking cycle. This was simply due to the indebtedness of Australian households, which are still feeling the pain of these higher interest rates. But with very strong employment numbers that are being sustained, I think that the RBA is going to be more reluctant to start to decrease rates until we start to see a substantial or meaningful uplift from those unemployment numbers. So I think that in Australia, we're possibly 1, maybe 2 rate cuts in 2024, but certainly the RBA will want to see probably a more moderate and measured decline or management of the reduction of interest rates as we head into the second half of 2024. 2024, excuse me, hasn't been all great news for China in particular. Their GDP numbers are falling and quite rapidly. Their equities are off some 23% in 2024, with the yuan down 7% itself. That's going to have material impacts to Australia in terms of the commodities that they obviously purchase and our largest trading partner. The level of household and private sector debt linked to the real estate sectors over there is causing them some concerns, and the inevitable collapse of Evergrande recently as well was no surprise. So China still obviously a big opportunity, but going to be facing some headwinds as we move forward. Finally, from a geopolitical perspective, this year we'll see almost half the world's population go to the polls, which is the largest number apparently in history. Obviously the big one there is the US election that'll happen in November later this year. I'm not going to make any early predictions on what is going to happen there. It's undoubtedly a circus, and Donald Trump's certainly in the headlines more and more and more, which is to be expected. What I will say in terms of investment markets, they don't tend to get as excited around elections as what the media purports. If anything, we'd expect to see a bit of an uptick in some volatility as the market tries to decipher the policies of or absorb the information and the policies that each party will put forward, but then tends to settle down quite quickly thereafter as the results are known. In terms of portfolios, our accompanying economic update will provide you with a bit more information as to those sectors that we're looking at, how we see those in terms of valuation and pricing and positioning. It's always very interesting for us to try and distill the amount of economic information down to a portfolio decision for you and how we manage money, and this time is no different to that, as the gap between bond yields and the reward that we obtain from the risk taken starts to narrow into corporate earnings or dividends, and as I said, that gap is increasingly narrowing, so watch this space. If you've got any questions, feel free to get in touch. Otherwise, we look forward to speaking with you shortly. Stay well. Bye for now.